Hello and welcome to India Market Open. We're waking up when global cues may not be too bad, guys, but it seems like the selling pressure may continue into today's day of trade. I'm just wondering, are we gone from a buy on dips to a sell on rise for the interim?
So the broader market is difficult to say, Samina, but I don't know. Somehow something tells me, I was speaking about this on Countdown as well as yesterday, and who are we to predict? But somehow felt yesterday that some bit of that correction seemed to be overdone. Thoda zyada ho gaya tha, but let's wait and watch.
Yeah.
Who knows, frankly.
Yeah, so this was something that Niraj was saying on the closing show, that maybe we're done with this bout of selling. But nevertheless, if you're looking for any kind of cue from what's happened overnight, then those at least are definitely positive. So let's go through those quickly. There is no breather that the bulls are taking on Wall Street. You're seeing this, every index hitting a new high. Yesterday it was the S&P. Today it is the Dow Jones that has hit a new high, a fresh record high. So you are seeing that kind of an optimism in the US economy, and US markets continue. Two very crucial pieces of information that will direct the next leg of this bull run. First, you're going to see Jan CPI data in the US come out later tonight. Remember, the December data was revised downwards, and that's what's given this rally legs, at least for now. You're also going to hear some Fed speak. A clutch of Fed officials are going to be commenting through the next few days, and that's what will be kept in mind. As a result, not too much action on the yields either, because it's a bit of a wait and watch mood. Crude is feeling the pressure because of Middle East crisis, etc., but not really moving this way or that. And very interesting piece I was reading, that's because of the amount of Russian crude India is buying. The quantum of Russian crude in India's basket has now gone up to 36%, beating what we buy from the Middle East. And as a huge buyer or a huge importer, that also is going to continue to have an impact on crude prices. But just Asia is looking good this morning. At least the Nikkei has also hit a record high. Nikkei over 37,000 for the first time. And let's pull up the entire Asia pack, where it's not looking too bad overall. At least Shanghai and Nikkei is okay. Hang Seng a little down in the red. Just a quick look at what happened yesterday, and I know Samina and Niraj will come to it in a bit of detail. It was the PSU stocks that were selling off, but who was selling off? If you look at the fund flows, no real clues there, because domestic and foreign investors were both buyers at the end of the day. Yesterday, of course, DII is in a much larger quantum. There is no doubt, though, that there was pressure. Now, was it the retailers coming in and looking at, now let's take some of those profits off the table? That's the question, isn't it?
Yeah, and so PSU led downtick yesterday, but it was not restricted. So, frankly, the Nifty was deceptive yesterday, right? Because if you look at the Nifty move, that was not the depiction of what was happening to portfolios. I mean, just speak to 5 people, post-market hours, and everybody was saying that the portfolios got a serious whacking. So the Nifty move yesterday, not a depiction of the pain in the portfolios. And frankly, just looking at levels per se, the max Nifty OI, put OI, is at 21,500. So that one is a key support. And if the index were to take stability at that level, it may well happen, right? Because in some senses, if you look at quant indicators, technical supports, and call and put OI, it seems that, who knows, we might find some support there because the world markets aren't doing all that bad, but that may not necessarily be indicative of what happens to individual stocks within portfolios, because frankly, two things. One, some of the rallies were overstretched. We've been talking it for a while. So can that extend further? Maybe can. Maybe some bit of buying may not come that easily in PSUs now that people know that the valuations are overstretched, and yesterday was a big crack. And two, I think the Bharat Forge comment yesterday would set the cat amongst the pigeons when it comes to export-oriented businesses. So not just auto ancillaries, I mean, which is of course the key thing, but some of the other exports businesses as well. And for all of you who might have missed it, I doubt anybody would have missed it, but for anybody who's missed it, look at what Baba Kalyani or the management of Bharat Forge has said. They're saying, and this is a repeat, but it is very important. They say that looking ahead in Q4 and further into FY25, we expect growth momentum to moderate. They are saying that they will outperform, but that doesn't mean anything, because if the growth momentum has significantly come off, outperformance may not necessarily lead to growth. And this morning we don't have the data as yet, but we were looking at yesterday. Effectively, a clutch of these expensive names came off, right? PSUs and some others. Chinmay, we don't have the data right now on the screen, but just before I hand it over to you guys, I asked our research team to just give a collation of some stocks which are trading expensive. So forget the internet stocks like Nykaa, PB Fintech, where the PE may not be the best depiction. But Landmark Cars is trading at an estimated P multiple FY24, 2024 at some 324 times. I mean, this is seriously expensive. Hitachi Energy 214 times. All Cargo Gati 189 times. Mahindra Lifespace some 150 times. These are Bloomberg estimated PE multiples, of course, so they need revision once these actual numbers come into fray. But even if you halve them, a lot of these stocks are expensive. So the broader market, some seriously expensive pockets, serious cleansing was needed. We saw the first bout, it may not be it.
Yeah, I think it may not be it. Most people are talking about another 5 to 10% correction, and this is healthy. I don't think we're still in an area where we're concerned. But just to put numbers to the PSU sell-off that we've seen, in the last 3 days, the wealth erosion from PSU stocks alone is to the tune of 3.7 lakh crore rupees. Now, putting this into perspective, if you just take a look at the historical returns, in calendar year 2021, PSU index was up 41%. In calendar year 2022, PSU index was up 23%. In calendar year 2023, we've gone up 55%. And here we are talking about a sell-off. I mean, if you just keep that in mind, what you're seeing right now is a drop in the ocean.
A little shade.
A little shade.
Not really a cut.
But it seems to have hassled a lot of people. A couple of other things. Across the PSU basket, the government, remember, owns 30 to 90% of stake. If I have to talk about what loss every vertical has had, institutional investors have lost 93,590 crores, non-institutions have lost 45,300 crores, and individual holders have seen wealth erosion to the tune of 36,440 crores. So when Niraj talks about how portfolios beyond the headline number have impacted, that is the erosion of wealth that we've seen. For the last few months, people have been talking about how valuations look stretched, but who's to call it a top or who's to call it a bottom, right?
Exactly.
It's anybody's guess. In retrospect, we can be sitting here and telling you this is what happened and this is why it happened. But like we said, value is like Niraj and Tammana discussed, is a pate Philippe in the Indian market context. But for now, PSU is not enjoying that. Well, I'll move away from that into another important factor. We'll talk about inflation as well, but maybe at a later stage, is earnings. 3 earnings that we had that I have picked this morning. You've had Coal India. Numbers were actually pretty good. Now, whether the markets are going to get excited about this is going to be something we'll have to watch out for. If the sentiment is lukewarm, I don't expect a big positive up move or a rest of sell coming in for Coal India. Profits were ahead of expectations. Revenues were up 2.7%. EBITDA was up by 10%. Margins have also expanded to 31% from 29.53%. Net profits were up around 17%. Key factors is raw coal production has also grown about 10.5% year on year. Raw coal offtake has also grown 8.8%. And of course, for investors, the board has declared an interim dividend of about 5 rupees per share. So a couple of positives. Now, whether that sell-off from yesterday will be arrested on back of these numbers is something we'll have to wait and see. But independently looking at those earnings, they're actually not a bad set of earnings coming in on Coal India. Another one that I did think looked good was Dilip Bilcon. Revenue was up 24%. EBITDA was up massively, 127% to 357 crores versus 157 crores. Margins have expanded to 12.4 versus 6.76, and net profit is also up marginally. A couple of factors you want to keep in mind. While there has been an impact of finance cost was higher by 20%, and that impact you're seeing on profitability, but not on EBITDA. And that's why while margins and top line looks better than what you're actually seeing on the bottom line. Other than that, you also had the order book that's come down from 27 crores peak to 21 crores. So while those numbers don't look too bad on the face of it, when you look a little deeper, the commentary seems a little more concerning at this stage. In good news, they won 4 new projects, and that is a good positive. 100% of the equity divested in the 9 HAM projects and 49% in the 1 HAM project. So those are the few factors you want to watch out for. Could be another rough day for Dilip Bilcon, to say the least. Well, HEG revenues were up 6%, EBITDA was down 34%. Margins have also contracted 950 basis points to come in at 15.4 versus 24.9. Net profit was down almost 60% YOY. What they've done is there was a 35 crore write-off of inventory that we saw. In the same quarter last year, there was a write-on of about 110 crores. So the impact you're seeing of inventory is to the tune of about 180 crores, which is impacting the numbers for HEG. So the numbers are not bad, but because of the write-off number, you are seeing that looking a little more distorted than it should. So all in all, I don't think numbers are going to come to the rescue of any of these companies, but nevertheless, they don't look too bad, at least for Coal India to begin with for now.
In note from Nuvama on Coal India, which is quite positive actually, they've maintained a buy. They've raised the target price to 561 and have said that Coal India has posted better than expected EBITDA on lower operating expenses. Volumes have improved and lower cost to drive earnings. So at least I would say one bright spot in that, government owned companies rainbow that we're looking at. Can't really say the same for SAIL. So Steel Authority of India's Q3 numbers are also out, and imports of steel have been at record highs in India because of construction demand, etc. This has impacted domestic companies. It's been seen on SAIL's quarter, so it's a disappointing quarter. Lower price realizations have hit profits, and this is something that the management has also said. And of course, it's the impact of those high steel imports. As a result, your revenues are down about 7%, your net profits are down about 22% for SAIL. A bit of a margin expansion, very mild, and the EBITDA is also up minimally, I would say about 3%. There is an interim dividend of just about 1 rupee per share. So that's one to watch out for. You might see a negative sentiment, already quite a bit of a crack yesterday in SAIL. Galaxy Surfactants is another one in mind, and remember, it's not just PSU stocks. Specialty chemicals have not had a great time overall, and we're going to be talking to the management a little later in the show. So it's the poor quarter continues. One of the things the management has said in its investor presentation is that the Red Sea escalation has impacted their volumes. We'll ask them how exactly. They also see a delay in North America recoveries, and as a result, you've seen revenues down about 13%, EBITDA down fairly sharply, nearly 27%, and profits down 32%. There is a margin contraction as well. Good news though for Phoenix Mills. Phoenix Mills has had a great quarter. You could even put it down to seasonality to some extent. That was a quarter when people like to shop, etc. So you've seen improved footfalls, improved occupancies at their St. Regis property as well. And they've seen rental growth up 5% in their mall, with overall consumption seeing a 25% increase. So if you were looking for a continuation of that theme, that at the higher end consumption is better, Phoenix Mills numbers definitely underline that. So you've had a pretty strong quarter. Revenues up 44%, EBITDA up more than 43%. Margins are up only at about 26 bips. So with that kind of a top line, still a bit of squeeze, but look at the net profits. You have about 62% up. There were some one-time sort of factors in Phoenix Mills as well, but overall I would say pretty good numbers.
Solid numbers, and the seasonality aspect would be true for the December quarter previous one as well. Maybe it ties in with the urban consumption uptick. So say for landmark cars, Tamanna, which had a slightly iffy quarter, I think all urban consumption themes have done really well, and this is really done really well for itself. So it could be interesting to see what happens to the stock reaction.
All that money you've spent in Phoenix Mills has worked out if you go shopping
No,
there.
unfortunately now we are going to BKC, right? Because we are right here in BKC, can't go to Lower Parel per se.
And you're only looking at the high end. That's what BKC is.
I'm looking at the high end, I'm not buying that, I must say. But no, it's a pertinent point. So Coal India, Phoenix Mills, we're looking at good stories. So I'm bringing only good stories today. I'm doing a change, okay? So 3 stocks which have done really well in the quarter. Sansera Engineering is the first one. By the way, at TTM 30 times, Sansera is not the most expensive stock, but look at the numbers. Sales up 27% at 713 versus 560 crores. EBITDA margins expand 140 basis points to about 16.9%. And PAT up 55% at 48 versus 31 crores. It was the highest ever quarterly sales and EBITDA. The order book expanded further as well at 2,040 crores, which is a 36% YOY growth in order book. I think the only question for everything related to aerospace, defense, and auto ancillary, which is where Sansera also fits in, is that what Bharat Forge just said yesterday about how their quarterly numbers were very good. They expect Q4 to be okay too, but pain beyond that. Could that hold true for a Sansera or some of the others as well? I think remains to be seen. Must say though, this is a far cry from the valuations that some of the others which have corrected yesterday is at. So therefore, Sansera could well have a good day today. Let's wait and watch. Slightly better than Sansera was Skipper. Revenues up 80% at 801 crores versus 444 crores. EBITDA up 69% and PAT doing really well for itself as well, about 115% uptick in PAT. So that too, that business has done really well for itself, and you should pay heed to the numbers that this one has posted, Skipper. I'm just trying to get you some other details for Skipper, because I think again for Skipper to the best ever revenue quarter led by strong performance across all of the major businesses. Polymer grew 11%, infra grew 17x or 17%, and the closing order book was very, very healthy. So do watch out for Skipper in the session today. And slightly better than Skipper on the bottom line front or the margin front was Ashiana Housing. Revenues up 44%, strong, not as strong as Skipper, but look at the margin expansion at Ashiana Housing. 1132 basis points, 17.58 versus 6.25. In these housing companies, it becomes difficult to predict whether it's a one quarter wonder or otherwise, but good quarter, and the PAT up 207%. So very likely that this will react positively too. So top three in my radar after Samina and Tamanna's are these. There are some others, but I'm sure you guys have noted something else too.
Just very quickly, I want to bring in Novelis, because those earnings for Hindalco were a big bump up. We will see the reflection of that, but just to take you through that, their income has risen to $121 million, which has grown tenfold over $12 million, which was seen the same quarter last year. Remember, Hindalco will also be reporting earnings, so this will be a sort of an indicator what we can expect as it is a subsidiary of the company. Net income has grown 80%, excluding special items. Net sales, though, have actually seen a little bit of a dip. But that's that for you. Another counter we've watched every morning has been Paytm. 197 communication, if we can bring that up on the screen. There was a little bit of relief in terms of what we saw in the stock yesterday. It was left out while the rest of the markets were selling off. Quick one, there's been a downgrade coming in from Macquarie now, where they've slashed the target price to 275 from 650. So a huge cut in their target price on of course Paytm. They've said transitioning to new banks looks very difficult for Paytm. They've said increased loss estimates by 170% and 40% over FY25 and FY26, factoring a 65% decline in revenue that they're expecting the current news flow to have on this entity. They're also assuming 50% cash burn rate and 20 times PE multiples to actually normalize earnings for the distribution part of the business. Lending partners might relook their relationship with Paytm. So those are the factors, and that's what they're very clearly concerned about. I don't think any of us can rule out another day of lower circuit on Paytm on back of that downgrade again.
The fact that Paytm was up yesterday, Samina, is interesting, because it was up on the news that their deadline of Feb 29th will be pushed forward. But what the market needs to understand is that, and of course it fell off its highs of the day, but the deadline is being pushed forward for customers to exit, not really as a reprieve for Paytm. And the kind of slash that Macquarie has done in its note, 275 is where they look at it. I mean, all right, let's put aside what their earlier target price was, 650. Perhaps that was at a different time. But price target of 275 now really, in a sense, underscores the concern about the survival of this payments bank business, at least. Why would anyone come back? Who else is going to come and rescue them? The fact that they say that transitioning to new banks looks difficult is an important factor. Really, because as we have reported on NDTV Profit, that you know, they reached out to several banks who did not want to come on board unless there was a very clear mandate from the RBI that whatever mess was allegedly happening in Paytm Payments Bank would not be on their books. There was a comment yesterday from Amitabh Chaudhary of Axis Bank saying once we get the go-ahead, we're happy to help, but they need that clarity from RBI. Harsh joining us in on more details of that Macquarie report. Harsh.
Well, yes, Tabana. So, you know, it's not surprising because you were going to see a second order impact of this happening. And what Macquarie is really detailing out is with regard to just the number of customers on the Paytm platform, which are 33 crore at the moment, will go down substantially because of a lack of confidence. One, what Macquarie is clearly suggesting is that there will be a fresh KYC required according to their channel checks. They are caveating that, but as per their channel checks, there will be a fresh KYC required for customers, which will basically impact that customer count of 33 crore, which Paytm has on its platform, which will impact the top line of the company by 58% in FY25 versus FY24. So that's a very, very large number in itself. And what they are suggesting is basis their price to sales valuation, which was used for deriving the 650 rupee target price. This impact on top line itself would push the target price to 225 rupees. That's a significantly lower number. So that's the first part. Second, they are suggesting that the lending business will get impacted because lending partners will lose confidence, and they're already doing that. As per their channel checks, AB Capital, which had around 2,000 crore of loans with Paytm, now has reduced that book to 600 crore, and they are expecting other partners to follow suit as well. So all of that will impact the top line as well as the EBIT. EBIT down 71% as per their estimates versus the earlier estimates that Macquarie put out.
Well, thanks for that, Harsh. One line message, muddy waters. It's okay to buy a business 20% higher when the trend changes. Why go out and bottom fish?
Yeah, and a target price of over 50% lower than the current market price. So it's painful.